Hi everyone, it's Naveen, your local real estate agent, and I do a lot of door knocking, and when I door knock, I meet people, sellers, buyers, investors, people with different real estate needs. And one of the questions I get asked is, if I sell my home in California, do I have to pay taxes on the profit I make? So let's take an example. For example, you bought a home for 200,000 and you are selling it for 500,000. Do you have to pay taxes on this 300,000 profit that you make? First of all, let me know where you are watching me from. Currently, I'm in our Upland office, and I would like to know where you're, watching from. If you're watching from California or out of state or out of country, and what city in California you're watching from. And also, if you have any questions about real estate, whether you are having any thoughts about selling or buying or investing, just so I can basically tailor and customize my future videos for you and exactly know my audience. Okay, let's go back to the question that I asked. So the answer is yes, because there's something called capital gains tax. So capital gains tax are taxes paid on any appreciable asset, such as your home. So is there any exclusion? Yes. There is up to 250,000 exclusion if you are a single filer, and up to 500,000 if you are a married couple filing jointly. So let's go back to our example. So if you bought the home for 200,000, you have up to 450,000 to sell your home without paying taxes, and up to 700,000 to sell your home if you are married and you are filing jointly. Okay, so the question is, can you have full exclusion? Is there anything like that? Can you be fully excluded from paying taxes? Yes, there are, and you have to meet all the criteria. And I tell you honestly, most of the people that I meet, people that just want to sell their home, they've been in their home for a while and they are looking to sell their home in the future to downsize or upgrade, then they qualify for that. So let's go through the qualifications and see if that applies to you. And basically, this qualification will give you like full, these 5 qualifications will give you full exclusion. The first, your home has to be, it has to be your primary residence, okay? So this home has to be your primary residence. Number 2, you've owned and lived in this home for at least 2 years in the past 5 years. And the years don't have to be consecutive. So say, for example, that you've owned this home for 5 years, and in the beginning you lived like a year, and then you skipped a little bit, and then you lived another 2 years, 6 months, for example, and then you skipped a little bit, and then you lived another 6 months. By all means, you just made 2 years. So this will definitely make you applicable for this. So the first thing is that the house has to be your primary residence, and number 2, you owned and lived in the home for at least 2 years in the past 5 years, and they don't have to be consecutive. And number 3, you did not acquire the home through a 1031 exchange within the last 5 years. So what is 1031 exchange? 1031 exchange is basically a tax rule that allows investors to exchange an investment property to another property. So basically, it's a rule that it defers the capital gains tax from one property and into buying another property through the proceeds of that property. So you sell one property, you take the proceeds, and you buy a similar property. This way you are deferring the taxes. We are not excluding it completely. It has to be paid one day. It just deferred from, at this time. So this is a 1031 exchange, and this property that has to be deferred through the capital gains, excluded from the capital gains taxes, it cannot be acquired through 1031 exchange within the past 5 years. Okay. Number 4, you haven't claimed the exclusion on another home in the last 2 years. So if you've claimed that exclusion on another property within the past 2 years, then this property that you are trying to exclude will not be, this rule will not be applicable to it. And number 5, you are not subject to expatriate tax. So expatriate tax is a government fee paid by those who renounce their citizenship or take up residency in another country. So if all these 5 qualifications apply to you, and again, as I said, most people, these qualifications will apply to them. In this case, then you are fully excluded, okay? And I just want to put a disclaimer out there that I'm not a tax specialist, absolutely. So this is just for your information. And you can take this information that I'm providing you with and take it and to your tax specialist guy, and if you are thinking about selling your home. But if you're thinking about selling your home, you can give me a call and I can give you a free estimate for your home and just chit chat with you about that and help you through this journey. So this is just information for you guys. Just take it to your tax specialist, and it's an important question because I get asked about it sometimes when I do knocking. But that's it about for this episode. And if you have any questions, feel free to write them down and I'll get back to you. Thank you so much for watching, and until next time, bye for now.